So what does higher inflation, interest rates, the new Fed chair, Kevin Walsh, mean for the markets? I mean, do you think that the inflation is here to stay? I mean, that's our view as well, but obviously I would like to understand what do you have to say?
There's been a lot of press about inflation lately, and most of it was surrounding what's happened in the Middle East. And one of the primary inputs, of course, for inflation, for productivity, are the input costs, and oil being a significant input, not just oil to run our automobiles and heat our many of the homes in the U.S., but of course inputs in almost every manufactured product, right? From clothing to plastics to metals to you name it, whether it's the energy that oil provides or oil as an actual input into these products. So that was a major concern as it relates to inflation. And of course, there's many, a whole other energy conversation would be about other sources of energy that are under development to offset the impact that oil, more expensive oil, can have in the future. So that does help from an inflationary standpoint. But what's not getting as much press is what the Fed is really worried about right now, and why the Fed can, even with oil prices declining, why is the Fed, and again, as to your point, new Fed Chair Kevin Walsh, whose first mandate was to come in and lower interest rates, and his first Fed meeting, they're now talking about 1 to 2 rate hikes. And the disconnect is, well, why would that be if oil prices are on their way down and there's potential, I'll put it in quotes, peace in the Middle East emerging? And the answer is, and we'll talk about more about the consumer later, but it is about the unemployment rate in the U.S. We're at a significant low in unemployment, which of course is a positive. We're at around 4% unemployment. Full employment in the U.S. is around 5 or 6%. And the employment picture has been clouded further by a shortage in labor caused by none other than, yes, you can guess, Donald Trump, right? As part of our immigration policies and closing our borders, not just to what he promised initially, which were the miscreants that could come into the country, but also productive labor as well. So that's created a labor shortage. And when you have a labor shortage, that impacts wages, right? Wages have to go up to attract labor. And wages can be one of the most important causes of inflation, because with rising wages, demand for goods and services goes up, and companies have pricing power then to raise prices. So the Fed is in an interesting position in that they don't have to worry about cutting rates as a result of economic weakness because of inflation. Rather, if inflation is caused by wage hikes, the Fed is in a somewhat attractive position to actually hike interest rates without harming the consumer necessarily. The market may not like that, but if the consumer is making more, if wages are going up, yes, that's inflationary, and the Fed can try and put a dampener on that with raising interest rates. But if inflation is due to rising wages, the positive aspect to that is that improves corporate earnings, because not only is more money spent, but more money is spent at higher prices, which improves corporate.
Sure.
And we know what the primary driver of stock price movement is over time. It's profitability. So if you have this consumer that's 2/3 of the U.S. economy, rising wages, they're spending more at higher prices. That's good for the equity markets. And again, if the Fed is able to use the tools that it has in the toolbox, primarily interest rate increases, and if we're only talking about maybe a few quarter point hikes in interest rates, that's okay. Now, that said, inflation does need to come down ultimately. That a 2% target is still real, but at least the primary inflationary causes with the decline in energy prices is a very healthy U.S. economy.
Yeah.